Hi everyone, Colleen McCoy here with Brick and Mortar Properties. I'm doing a quick little video to explain cap rates today. So if you've heard in investment blogs or articles talking about what the cap rate is, we're going to talk about that and explain further. So basically, you figure out what your net operating income is and you evaluate that to the purchase price if you're looking to purchase an investment property. It's really just a simple formula that you can calculate relatively easy to determine whether the purchase price of the property you're looking at even makes sense compared to the income it's going to generate and part of the expenses. So for example, cap rates equation is the annual net operating income. So basically, all of your gross rents for the year, your annual gross rents, less expenses divided by the cost of the property. So $100,000 property, net operating income of $10,000 a year. Divide that out, it's 10%. You might be asking what expenses are included in the net operating. Those would be property taxes, insurance, maintenance, repairs, vacancy rate, property management fees. Basically everything except for financing. So a mortgage on the property, any type of money being borrowed, you would not include it in this calculation. So for an example, we'll dig in a little deeper. $100,000 property, rents for $1,500 a month. So your gross annual income would be $18,000. Then we'll go ahead and we'll subtract out taxes, insurance, maintenance. Always try and do 10% for vacancy, just in case you have a month of turnover for some reason. Property management fees. So you subtract out your $18,000 less your expenses, and that gives you your net operating income of $10,000. Why are they useful? It's a quick way to evaluate the return on a specific property. So if you're getting sent automatic listings every day on investment properties, figure out where you're comfortable with that cap rate being. For example, your security bonds are going to be at 3%. So obviously, investment properties are a higher risk investment, so you would want the cap rate to be higher than what a secure investment would be. You compare these cap rates to other properties that you're looking at. So you get sent maybe 10 listings on multifamilies. You want to quick and dirty just run the numbers to see if the cap rates are even worth investigating further. At that point, you can figure out cash flow, cash on cash return, all sorts of other equations that we'll get into at another time. But this is just your initial, is it worth moving forward? When are they not useful? When you're using financing, typically other equations are a little bit more useful. Seeing as this doesn't take into a mortgage into effect, it definitely kind of skews the data a little bit. Let's see what else. All right, we talked about the return. So basically just going back, here's your equation. Again, your gross annual rent, so whatever you make monthly on your rental, multiply that by 12, subtract out your expenses, your operating expenses, and those again, taxes, insurance, maintenance, vacancy, property management fees. And then you're going to divide that by the price or cost, and that's going to give you the percentage. In the market, a lot of the homes that you're going to see are going to be around 5, 6, 7, 8% cap rates. I probably wouldn't go much below that 5, just because you're taking on a bit of risk without very much return. So if you have any questions though, feel free to give me a call. Have my info on there. Website's brickandmortarrental.com. So Thanks for watching. Have a good one.